how the 2021 ASIC reforms will affect the finance sector. The world's financial markets are roaring more than ever before. You are talking about a market with nearly $6 trillion in daily trading volume. No other sector comes close to this, and that's why millions and millions of people worldwide are being drawn into this industry. And due to this huge scale, there must be strict regulation by financial market authorities, otherwise the naive may suffer untold losses through actual trading and scams. Every country or region in the world has its own regulators. Top forex regulatory bodies. Locally speaking, the regulatory body that looks into the interest of Australians is the Australian Securities and Investment Commission, ASIC. Other notable regulatory bodies in the world include Financial Conduct Authority, FCA in the United Kingdom, Cyprus Security and Exchange Commission, Financial Security Board in South Africa, Commodities and Futures Trading Commission in the United States, Financial Services Authority in Seychelles, Dubai Financial Services Authority. The need for regulation. While each of these regulators has its own sets of rules, their main function can be summarized into the following. To ensure only people with certain industry qualifications are allowed to run forex brokerage firms. To ensure that forex brokers keep a separate bank account for traders' funds to avoid using investors' money to cover operating costs. To ensure forex brokers submit accurate periodic reports on their activities for transparency purposes. To restrict forex brokers who engage in fraudulent practices from operating. To set the standards of operating for forex brokers. The ASIC 2021 changes. Having understood the role of forex regulators, you agree that they have a right to update their regulations whenever the need arises. This is exactly what the ASIC did in April 2021. Before detailing the exact 2021 CFD Australian changes, it pays to understand what led to the institutions to make these changes. Here are the main factors that informed their decision. Number one, the COVID-19 pandemic. The entire world was brought to its knees at the beginning of the year 2020 when the unknown SARS-CoV-2 virus spread from China to all countries in the world. Lockdowns became the order of the day, with most people spending the entire day indoors and many having lost their jobs or receiving pay cuts. The idea of making money online led quite a section of the population into forex trading. New forex trading accounts were created 3.4 times more than before the pandemic struck. You can't claim that such new entrants fully understand what they are getting into. Many are actually lured into the forex business as a result of misrepresentation of the industry as to get rich quick scheme. Little do they know that it takes proper education and wide experience to emerge successful in the financial markets. Additionally, those with dormant accounts activated them in a bid to renew their forex dreams. 1,402,022 to be precise. It's no wonder that these Australian traders lost a whopping $428 million in only 1 week in April 2020. Number two, higher incidence of slippage. Forex and CFD trading involves the setting of buy and sell orders as well as stop loss and take profit orders at specific price levels. When the market price reaches these levels, the orders should be automatically activated. These usually happen without any problem, but the trouble sets in when volatility gets high. You'll find your orders getting executed at different price points than that which you'd specified. In worst case scenario, In worst case scenario, the order may completely fail to execute. This is very dangerous as it may wipe out your account in seconds. For instance, assume you'd placed a stop loss order to limit your losses in a particular trade to $100. If the order fails to activate, it means that your losses for the particular trade will continue increasing beyond $100, sometimes until your account goes to negative figures. Number 3, higher incidences of market gaps. Gaps in the market can also occur during high volatile market conditions. In the same example above, the price of the forex pairs you are trading may jump to the negative side of your stop loss order, meaning that you incur higher losses than you are prepared to. Number 4, high percentage of losing trades. Perhaps you've come across the wild claim that 90% of all forex traders are never profitable. Official statistics by ASIC didn't fall too far from this. During the extremely volatile market conditions in April 2020, about 56.9 and 63.2% of retail traders were making huge losses. The figures were even higher in other countries for most of the top brokers. For instance, the XTB Forex broker had 75 to 82% of all their traders lose money in the year 2020. The 3 ASIC 2021 changes. The statistics are pretty alarming, and you wonder why an industry has more losers than winners is still attracting more and more people. Perhaps it's the people's desire for quick riches or the non-availability of better revenue generating opportunities out there. All what the regulatory bodies can do is to protect the public from unintended loss or great sums of money. Thus, ASIC updated its Forex and CFD trading regulation into 3 major areas as discussed below. Number 1, reduction of maximum leverage. Forex is traded in units of volumes called lots. One standard lot is equivalent to $100,000. That's quite a lot of money, but most forex brokers allow retail to trade in fractional lots. So instead of one standard lot, you can trade 0.1 lots. This is referred to as the mini lot and is equivalent to $10,000. 0.01 lots, this is referred to the micro lot and it's equivalent to $1,000. 0.001 lots, this is referred to as the nano lot, that it's equivalent to $100. The minimum trade lot size for most brokers is 0.01. You'll agree that it may be difficult for most people to raise $1,000 so as to invest in the financial market. But since forex brokers want many retail traders as possible to sign up with them, they offer you what is known as leverage. Suppose you are given a leverage of ratio 1 to 10. It means that you can control trade sizes 10 times more than what your forex account balance would normally allow. And if the leverage is ratio 1 to 500, you can make trades of volumes 500 times bigger than your actual account price. The arrangement is good and bad in that it enables you to make more profits with a smaller account, but also exposes you to risk of losses. In actual fact, financial market traders recommend that you use a leverage not more than 1 to 20. ASIC reduces the maximum leverage for Australian regulated forex brokers to 1 to 30 for major currency pairs, 1 to 20 for minor and exotic currency pairs, 1 to 20 for gold, commodity and other major stocks exchange index CFDs, 1 to 10 for non-gold commodities trading and minor stock exchange index CFDs, 1 to 5 for other assets and referencing shares CFDs, 1 to 2 for crypto CFD trading. The previous cap was 1 to 500. This bold move has the following obvious implications. Retail traders will have reduced risk when trading and also reduced profit potential. Maximum deposit requirements for retail traders will have to increase. Some brokers offer minimum deposits as little as $10. You can no longer make even a 0.01 lot trade with such an account balance if the leverage is 1 to 30. Many Australian traders who swear by high leverage may ditch the ASIC regulated forex brokers and sign up with overseas brokers that provide higher leverages. ASIC regulated forex brokers will have less profits due to the decreased trade volumes and abandonment by retail traders. Number 2, stricter trader protection. It's now a requirement by ASIC for all forex traders to close out all the open positions of retail trader before they lose all their money. You remember the issue of negative balances due to slippage and market gaps discussed at the beginning of this article? That should never happen again. Once the new regulations take effect on 29th April 2021, once your margin levels gets to 50% and all open trades get automatically closed so that you don't incur any further losses. In no way your account gets to negative figures. This second move has the following implications. Retail traders will no longer have to repay the broker as a result of having negative account balance. Forex brokers will have to cover the losses in times of slippage and market gaps. Forex brokers may have to increase their spreads and commission charges in order to cushion themselves against losses, but this may force retail traders to look for cheaper forex brokers. Number 3, restricted broker promotions. Forex brokers have to use all tricks to lure non-suspecting new retail traders into their business and has surprisingly had more losers than winners. Some of the tricks include discounts for higher volume trades, sign-up bonuses, rewards when you refer a friend to your broker, misrepresentation of forex trading as an easy get-rich-quick venture. To protect the naive person from getting lured to trade the financial market, ASIC has restricted brokers from offering gifts to retail traders and discounts to those who trade more frequently and in higher volumes. This move will affect the players in the financial market in the following ways. Forex brokers will have fewer new entrants creating accounts in them since there is nothing to entice them. Green individuals won't be cheated into depositing money for forex trading. The bottom line, ASIC exists for the good and of both active and potential retail traders. They are there to stop forex brokers from minting the last coin from your pocket. The 2021 ASIC reforms are good for retail traders and bad for forex brokers.